If you've got a digital business, you've probably thought about structuring it overseas because it doesn't really need to be in Australia. Look, you're right, and I set up these kinds of structures all the time. If you're going to have an outwards facing international business structure, you need to get a lot of advice and do it properly. You'll commonly have an Australian head company which will own your foreign subsidiary that's going to do something. This is going to be in the UAE, Singapore, Hong Kong, maybe somewhere even more exotic, depending what you're doing. And funnily enough, a dividend from that foreign company, if it's from that foreign company to an Australian company that owns more than 10%, that dividend is actually tax-free in Australia, which opens up huge tax planning opportunities. It's called the participation exemption or 768A exemption. But say you've got these profits in the Australian head company, what you're going to do is instead of investing through a family trust, you may actually say, well, I don't want to pay out that dividend in Australia and pay 47% tax on it. I might just lend it to a sister company to invest in real estate, stocks, whatever you want. So this is pre-tax profits that you can essentially invest, and all you lose is just the CGT discount. And look, we do like the CGT discount, but instead of paying 25-30% tax on your profits, you pay zero, and then you lose that concession. You often work out better off in the long term. The catch is you need to create actual economic risk, assets, value in these foreign companies for this to work. Otherwise, it's at risk of being attacked by the ATO. If you want a cool structure, make sure you get in touch.